Investing can be one of the most reliable passports to a better life, but where should you invest your money? Effective Investing by Mark Dampier brings together everything he's learned from grilling fund managers, weighing up investments and prospering through dramatic ups and downs. His book promises an answer on how to succeed as a DIY investor. Mark joins me now. Well, Mark, surely investing is for the experience, as after all, it's easy to lose a lot of money if done wrong, no?
It's not actually incredibly difficult, it just takes time, and I don't think people are patient enough. But if you think about what's happening in the world today, particularly in the UK, there's more and more emphasis on you doing it. No one else is going to do anything for you.
Well, you actually started your career in investment when the UK was coming out of one of its worst economic crises in history, when it was just coming out of the Second World War. So can you draw any parallels to today? What should investors be aware of and take away from this?
Well, don't be trapped in your own history, because that was a very different recession to what we've just been going through. Youngsters who haven't ever seen interest rate rise will never think that interest rates could ever be at 10% again. But in my day, when we had interest rates at 15%, we could never believe that interest rates could be below 5%, let alone where they are today. The financial crisis is completely different. It's a completely different kind of recession, if you want. Didn't come with rising interest rates. And so it's kept things going for longer, if you want, because we've got very low interest rates.
So you can't learn anything from the past?
Well, you can learn things from the past, but you don't. But the danger is not to extrapolate exactly what will happen. The history kind of rhymes to some extent, but it doesn't exactly repeat itself. Bear in mind that recessions and, well, financial crisis was definitely more of a one-off, I would hope anyway, but they come around every 10 years or so. So don't think that it's a sunlit uplands all the time when you invest money. There will be bad times, and that's the real test for an investor. Can you see through the bad times? Because too many people then sell out at a low point and don't wait. And one of the things I say is you've got to be patient with investments. And I think sort of masterly inactivity, which doesn't sound the right thing, but actually buy good investments, hopefully, and stick with them. Don't keep trading in and out. The idea of that you can buy and sell all the time is completely wrong.
You said that you've learned from your own mistakes. What sort of mistakes are we talking about? What can investors take away from this?
They shouldn't be trying to invest on an emotional level at all and not get excited and sucked in with latest technology, things like that. I mean, right now we're in a great, if you want, technology revolution. It's been going on for 10 or 15 years, and it's very easy to get sucked into the latest development. When Ford brought out the Model T Ford, he'd gone bust twice, and there was 100 auto companies plus in New York at that time, and so few succeeded. So don't necessarily get sucked into the latest thing. Open your eyes, look what's happening in the high street. You could have picked up Apple shares years ago if you're into buying the first iPads that came out. You could see the success, you could see the queues for these sorts of things. Share price didn't really reflect that.
And looking at more seasoned investors now, and of course there's the old adage, you can't train an old dog new tricks. So what sort of common mistakes do they make?
My mistakes have been, and their mistakes often been, buying too specialised funds, for example. You know, if you think about a fund, it's a broad spread of investment. But in fact, you can buy funds now which are devoted to, say, oil or some technology, single sector stuff. Pharmaceuticals, biotech is another good example. And biotech's done fantastically well in the last 5 years. But in the previous 5 years, it was terrible. So if you're going to buy things like that, you need to buy them when they're absolutely dead. Experienced investors should really realise that buying past performance doesn't buy you that for the future.
Well, it's as Warren Buffett said, buy low, sell high, but few investors do this. Why?
Because psychologically it's really hard to do. Think about it. When the news is really good, it feels good, but when the news is bad, let's take the depths of the financial crisis. Lehman Brothers had just gone bust. There was problems with the financial system. Would you have bought then? That was the time to buy, but it'd been really, really hard to do that. And one of the things I say is if it feels deeply uncomfortable to invest, that's probably a good time.
But there are, of course, a lot of bad investments out there that just won't turn around. So how do you sort out the wheat from the chaff?
Again, that's hard, but in funds, there's over 3,000 funds, of which I say about 90% are rubbish to start with. And one of the things you can look for is look at the lists that financial advisors produce. So you could take 4 or 5 of those and start sort of cross-referencing and then start your own universe. And there's probably only about 50 funds possibly worth actually buying. These are active funds, not passive, but that would be a great way to start.
So when approaching investments, do you think long-term is better or perhaps short term to turn a quick profit?
Short-term investment doesn't normally work. If you mean just a year or 3 years or something like that, you really, to make real money, Warren Buffett made money over 20, 30 years really, and he didn't look over a year or 2 years, and he was buying in 2008, he wasn't selling. So that's the sort of time frame you really need to look. You might as well do premium bonds or the lottery if you think, but you won't make a quick buck by doing that way. That's just kind of sheer luck. Make sure you have enough cash and invest for the long term, and I mean 10 years plus.